Politicians are talking up a new key to affordable home ownership, a 50-year mortgage that could save you a little money each month. But what if that key is really a trap designed to lock you into hundreds of thousands of dollars in extra debt? Before you even think about this solution, you need to see the math they hope you'll ignore. Because the real story here isn't about the monthly payment. It's about the staggering, almost unbelievable long-term cost. Let's be honest. The dream of owning a home feels more and more out of reach for millions. It's a problem that goes beyond politics and affects families all over the country. Home prices are stubbornly high, and while mortgage rates have come down a bit from their peaks, they are still more than double their pandemic-era lows. In many areas, the typical household is spending far above the 30% of their income that financial experts have long recommended for housing. The numbers don't lie. According to a 2025 report from the National Association of Realtors, NAR, the median age for a first-time home buyer has stretched to a record high of 40 years old. While some other data from the New York Fed suggests the average age is closer to the mid-30s, the trend is clear. People are waiting longer. They're putting their lives on hold because that core piece of American wealth, a home of your own, feels completely out of reach. We see it in wedding registries, where it's increasingly common for couples to ask for cash for a down payment instead of traditional gifts. They aren't asking for fine china, they're asking for a fighting chance. This desperation creates a huge demand for a solution, any solution. And when people are desperate, they're vulnerable. This is where the 50-year mortgage comes in. Pitched by political figures as a complete game changer, it's sold as a revolutionary way to make homes affordable again. The idea sounds simple. Stretch out the loan and you lower the monthly payment. On the surface, it seems like just what the market needs. But those promises have some serious strings attached. The main argument for the 50-year mortgage is incredibly tempting because it tackles the biggest headache for homebuyers, the monthly payment. When you're staring at a budget, every single dollar counts. Lowering that payment even a little can feel like the difference between getting a loan and getting rejected. So let's look at the math from their point of view. We'll use a realistic example. Buying a $400,000 home with a 10% down payment, leaving you with a $360,000 loan. First, let's imagine both a 30-year and a 50-year loan have the same interest rate, say 6.25%. Now, in the real world, this would never happen. A longer loan is riskier for the bank, so they charge more, but we'll get to that. With a 30-year fixed mortgage at 6.25%, your monthly principal and interest payment would be about $2,217. That's the number you have to fit into your budget for 3 decades. Now, let's stretch that same $360,000 loan over 50 years. At the same rate, your payment would drop to around $2,045. That's a savings of about $172 a month. That's money for gas, groceries, or daycare. For a family stretched thin, that isn't nothing. It's a little breathing room. This is the sales pitch. This is the myth. The lower monthly payment can help you qualify for a loan you couldn't get otherwise by improving your debt-to-income ratio. Proponents argue this gets your foot in the door, and it's better than paying rent forever with zero equity. They'll tell you that you can always refinance later when you're earning more or when rates fall. It's a powerful argument because it offers immediate relief. And if that was the whole story, this would be a very short video. But it's not the whole story. Not even close. Now let's look at what they're leaving out. This is the part where the 50-year mortgage dream crashes into the wall of reality. This is the math they're counting on you to ignore. Let's go back to our $360,000 loan. That monthly savings felt pretty good, but what's the true cost over time? Let's calculate the total interest. On the 30-year mortgage, you'll make 360 payments of about $2,217. Your total payback is roughly $798,000. Subtract the $360,000 you borrowed, and your total interest cost is about $438,000. That's a huge number, but it's standard for today's market. Now, hold on tight. On the 50-year mortgage, with your lower payment of $2,045, you'll make 600 payments. The total amount you pay back is a jaw-dropping $1,227,000. Subtract the original $360,000, and your total interest is about $867,000. Let me say that again. You pay nearly double the interest. To save $172 a month, you've agreed to pay an extra $429,000 in interest to the bank. You're basically paying for the house twice over and then some. And remember, that was the best case scenario, assuming the rates were the same. They won't be. Lenders see a 50-year loan as much riskier, so they'll charge a higher interest rate. Estimates suggest the rate could be 0.3% to 0.5% higher. Let's rerun the numbers with a more realistic rate for the 50-year loan, say 6.75%. Your monthly payment is now about $2,152. Your savings, compared to the 30-year loan, has just shrunk from $172 to only $65. And your total interest paid it skyrockets to over $931,000. Now the trade-off is horrifying. You're saving just $65 a month in exchange for paying nearly $500,000 extra in interest. Would you sign up for that? When you see the full picture, the deal looks less like a lifeline and more like an anchor. The massive interest cost is just the first part of the trap. The second, and maybe even more dangerous part, is how a 50-year mortgage destroys your ability to build wealth through equity. Equity is the part of your home you actually own, the difference between its value and what you owe. Mortgage payments are front-loaded with interest. In the beginning, most of your check goes to the bank's pocket, while a tiny fraction pays down your actual loan balance. With a 50-year mortgage, this is stretched to an almost glacial pace. Let's go back to our $360,000 loan at a realistic 6.75% for the 50-year option. After 10 years of payments on a standard 30-year mortgage at 6.25%, you would have paid down about $72,000 of your principal. You've made a real dent. Now look at the 50-year mortgage. After the same 10 years, you would have paid off only about $23,000 of your principal. You've made 120 payments, totaling over $258,000, and your debt has barely budged. Let's jump ahead to 20 years. With a 30-year mortgage, you would have paid off about 46% of the loan. With the 50-year mortgage, after 2 full decades of payments, you've only paid off about 11% of the principal. You still owe almost 90% of what you borrowed. One analysis showed it would take nearly 40 years just to pay off half the loan. Why is this so dangerous? Because it traps you. Life happens. People move for jobs or growing families. The median time a homeowner stays in their home is around 11 to 13 years. If you have a 50-year mortgage and need to sell after 12 years, you'd find you have built almost no equity. After closing costs, you could easily walk away with nothing, or even find out you owe more than the house is worth, a situation called being underwater. This makes it incredibly hard to sell and move on. It also makes it nearly impossible to refinance because lenders require you to have equity. You're stuck. The tool that was supposed to be your key has become the lock on your financial prison. You aren't building wealth, you're just servicing debt. Beyond the terrible math for one person, widespread 50-year mortgages could throw the entire housing market out of balance, making the affordability crisis even worse. The most obvious effect is on home prices. What happens when you suddenly give thousands of buyers a little more purchasing power? They start bidding against each other. When more people can qualify for loans, it increases demand for a housing supply that is already way too low. Basic economics tells us prices will go up. We saw it happen when interest rates were at historic lows. Buyers flooded the market and prices went through the roof. A 50-year mortgage could do the same thing. Any savings from the lower payment would be wiped out by higher home prices. The policy would just subsidize price inflation, helping sellers while leaving new buyers in a worse spot, paying an inflated price with a dangerously long and expensive loan. Some have compared this to the auto industry, where lenders introduced 7, 8, or even 10-year loans. It made the monthly car payment seem cheaper, but the average price of cars shot up. A similar outcome in housing would be a disaster. There are also serious questions about whether these loans are predatory. Federal guidelines exist to protect consumers from harmful loans. A loan that nearly doubles the interest cost and crushes wealth creation for a tiny monthly savings could fall into that category. These loans are most likely to attract the most financially vulnerable consumers, those who don't fully grasp the long-term cost. This isn't just theory. Other countries have tried this. In the late 1980s, Japan introduced 3-generation loans that could last up to 100 years during a massive real estate bubble. When that bubble burst, it contributed to widespread defaults and devastating economic fallout. Pushing a similar product into an already strained US market is playing with fire. So if the 50-year mortgage is such a rotten deal for the average person, why is it even on the table? To answer that, just follow the money. The most obvious winners are the banks and mortgage lenders. A mortgage is an asset that generates interest income. A 50-year mortgage generates that income for 5 decades. The longer you're in debt, the more money they make. The second group of beneficiaries, home builders and the real estate industry. Any policy that juices demand without fixing the supply shortage is a jackpot for them. It lets them sell more homes at higher prices. The affordability problem isn't solved, it's just papered over with more debt, and they get to cash the check. Finally, you have the politicians. The housing crisis is a huge, complex problem. Fixing it is hard, slow work. The 50-year mortgage, on the other hand, is an easy answer. It lets politicians look like they're doing something without doing any of the hard work of real reform. The 50-year mortgage is not a solution. It's a symptom of a broken system. It treats the symptom, the high monthly payment, while making the disease, the inability to build wealth, so much worse. The goal shouldn't be to get people into a house at any cost. It should be to put them on a path to financial security. Let's bring it all back home. The 50-year mortgage offers a tiny monthly saving, but at a catastrophic long-term cost. You pay hundreds of thousands more in interest, you build wealth at a snail's pace, and you risk getting trapped. It threatens to inflate home prices for everyone and mainly benefits banks and politicians, not the people it claims to help. This isn't a key to the American dream. For most, it would be a 50-year nightmare. Real solutions mean addressing why homes are so expensive in the first place, not finding new ways to chain people to debt for their entire working lives. The debate over the 50-year mortgage is a perfect example of why financial literacy is so important. You have to be able to look past the sales pitch and do the math for yourself. My take is that a 50-year mortgage is a trap. But what do you think? Is this a necessary evil for a desperate market? Or is it a predatory product in disguise? Let me know your thoughts in the comments below. And if you want to keep getting honest, no-nonsense financial analysis that helps you avoid traps like this one, make sure you're subscribed to the channel. Thanks for watching.